So if we continue, so we're looking at the compound instruments. So let's look at this illustration. You have this company which has issued 1,000 convertible bonds on 1st January X1 at par. Each bond is redeemable in 3 years' time at its par value of 2,000 per bond. The bond pays interest annually in arrears at an interest rate based on nominal value of 6%. Each bond can be converted at the maturity date into 125 $1 shares. The prevailing market interest rate for 3-year bonds that have no right of conversion is 9%. Now, we stated earlier on that the convertible bond should be split between the equity component and the debt component.
Yes.
You'll be given 2 rates. Okay, you'll be given 2 rates.
Okay.
The rate you use for discounting is the higher rate.
Okay.
A bond which is redeemable will have a lower rate compared to a bond which is non-redeemable. Will pay a lower interest. So to have a lower interest rate. Okay? Because the holder, they've got that right, that option, okay, that privilege to become shareholders, hence the bond paying a lower rate.
Okay.
So use the lower rate to compute the interest and use the higher rate to discount. Now, this rate, this bond is a 1,000 bond. Each bond is 2,000. So the bond has got a total value of 2 million. Interest 6% times 2 million will give us $120,000 as interest. Now, you are given in the question the 6% interest rate. You are also given simple interest and cumulative. You use the cumulative to discount the higher cumulative to discount the interest over the period in which the bond will be redeemed. In this case, 3 years.
Okay.
Then the simple rate, you use it to discount only in the last year when the principal will be repaid. Okay, so there will be interest in year 1, year 2, year 3. Those you discount using the cumulative discount factor. Then the principal, which is paid only once in the last year, you use the simple interest.
Which simple interest do we use, the higher one or the lower one?
I just explained that you discount with the higher rate.
Yes.
You always discount with the higher rate.
Okay.
The questions will give you 2 rates to confuse you, but you discount with the higher rate.
Okay.
So that's the illustration there. Start from the workings. let's say 1,000 bonds, each 2,000, giving us 2 million. We discount it with a discount factor for year 3 to give us 1,544,000. Then we compute the interest over 3 years, discount the interests using the higher cumulative for the higher rate to give us a total of 303,720. Then you add the discounted principal and the discounted interest to give you 1,847,720. Okay. The bond we said was valued at how much? 2 million. So 2 million subtract the 1,847,720 gives you the 152,280 as the equity component. Clear?
Yeah.
We move to recognition. Financial assets and liabilities, they take a different form of recognition from what we've seen in other standards, most of those which are based on the conceptual framework.
Okay.
Financial assets and liabilities require that they are recognized in the statement of financial position when the entity becomes a part to the contractual provisions of the instrument.
Okay.
Remember the other criteria? The recognition criteria we looked at before in the other standards requires that you recognize an asset when it is probable that there will be an inflow or outflow of resources, and the items can be, the cost of the item can be measured reliably. Distinguish these two for financial instruments. So we're looking at recognition. So we're saying financial assets and liabilities are recognized when the entity becomes a part to the contractual provisions, okay, which departs from the conceptual framework of recognizing when there is a probable inflow or outflow of resources which can be measured reliably. Clear?
Yes.
Derecognition, when do you derecognize a financial instrument or a financial liability? Okay?
Is that the same as all the other things we've done? The probable cause and everything?
Come again?
Is that the same as everything we've been doing in the past? The probable cause and all of those?
What do you mean is that?
Like for all of them, recognition is the exact same.
Most of the ones we've looked at, if you go back and check what we've looked at, most of them, they use that conceptual framework criteria.
Yes.
There will be one or two which will have an addition, a third one, but most of them have got those two.
So the ones that are always there would be the probable the future economic benefits.
You have to know for each standard.
Okay. So they're not constant at all.
No, you have to know for each standard. What I've given you is what is used for those standards.
Okay.
Yes. So do not try to memorize, think that they all use the same criteria, no.
Okay.
Yes. What I said that most of them use that criteria.
Okay.
Yeah. Now, think of, let's assume I owe you some money.
Okay.
You'll be showing a record that I'm owing you some money.
Yes.
I'll be showing, so to you, it will be an asset
Yes.
because you're supposed to receive. To me, it's a liability because I'm supposed to give you. When are you going to write off from your books that asset?
When it's paid to me.
When I've paid you.
Yes.
Equally, when I pay you, I'll also write off the liability from my books.
Yes.
Okay, that is the recognition.
Okay.
Okay, so with financial assets, when the contractual rights to the cash flows expire, okay, either because the customer has paid their debt or the option has expired worthless, or you've forgiven me.
Okay.
Okay? Or it could happen that you could go to Mr. B and sell off those rights. Tell Mr. B that I owe you. If Mr. B can pay you, then Mr. B can chase up with me.
Okay.
So if Mr. B agrees and you transfer all the rights to him, then you can recognize that asset from your books.
Okay.
Okay. On my part, our liability I would recognize when I have paid you, or when you have written it off, you have cancelled it, or those rights for me to pay you expire. Clear?
Okay. Yes.
We move to the measurements. Measurement, like we've seen before, there is initial measurement. Financial assets also have initial measurement.
Okay.
A financial asset, initially it's measured at fair value plus transaction costs. Okay. For those financial assets not held at fair value through profit or loss.
Okay.
Now the fair value, because most of these assets, they are trading on the market, so the fair value is usually taken to be the market price.
Okay.
Okay? Although in some instances this may not be the case.
Okay.
Now, just like most of the standards we've looked at, after initial measurement, there is also subsequent measurement.
Okay.
With financial assets, subsequent measurement depends on a number of criteria. The first criteria is that if this financial asset is debt, now this debt, the business model is that the debt is held to collect cash flows which are principal plus interest. Meaning the holder of the debt will be collecting interest, eventually interest and principal. Then the subsequent measurement will be at amortized cost.
Okay.
Take note, amortized cost is used for debt.
Okay.
Amortized cost is used for debt which is held to collect cash flows of principal and interest. Okay, we continue with subsequent measurement. The other is equity. If an entity has an investment in equity instruments not held for trading, this will be through fair value, through other comprehensive income. Now, let me qualify.
Okay.
This is optional. For investments in equity instruments not held for trading, an entity has an option to measure such an equity instrument through fair value, through other comprehensive income.
Okay.
Now, this election must be done at inception of the equity instrument. And once the election has been made, the instruments, the gains or losses, they go to other components of equity. These gains will not be reclassified, cannot be reclassified to profit and loss. Okay. Although the dividend income will continue to be recognized in profit and loss. Clear?
Yes.
So look out for that election in the question whether management has made that election.
Okay.
The question will tell you that management has made the election. So anything else which will not go in amortized cost or where there is no election, everything else will go through fair value, through profit or loss.
Okay.
Okay?
Yes.
It's at subsequent measurements where you have to be very careful when you're answering questions. That's where the tricky part usually tends to be.
Okay.
Okay, we move to financial liabilities. Financial liabilities also there is initial measurement,
Okay.
and subsequent measurement.
Okay.
At initial measurement, the financial liabilities is measured at fair value minus transaction costs. You need to distinguish between a financial asset. Financial asset is plus, financial liability is minus transaction costs.
Okay.
Equally, the financial liability also has got subsequent measurement. Subsequent measurement, just like the financial asset, will also depend on some criteria. Most financial liabilities are measured at amortized cost.
Okay.
But the standard allows some financial liabilities to be measured through fair value through profit or loss, such as financial assets which are held for trading, or those financial, did I say financial assets? Financial liabilities.
Yeah.
Financial liabilities held for trading, and those financial liabilities which have been designated at fair value to eliminate or significantly reduce an accounting mismatch. Now, most questions here is just a theory. You need to be able to recite what the subsequent measurements are. Okay. All others, those which don't go through amortized cost or through fair value, through profit or loss, they can use other bases, such as where financial liability arising when you transfer a financial, when a transfer of a financial asset does not qualify for the recognition. Okay? Again, most of these, they are best understood through questions. Financial instrument is one of those courses, topics where just reading the notes will not prepare you adequately for answering questions. You need to practically do the questions to grasp the concepts.
Okay.
Okay?
Yeah.